Welcome to Markets Now. I'm Michelle Rook with Don Rose U.S. Commodities. Grains all ending to the plus side on Friday with a nice rally in a lot of sectors. And, how much of this has been putting weather premium in, Don? South America versus U.S. weather premium, which is it?
Well, I think most definitely that's what we did. We added risk premium to the market from weather. That's always the great equalizer. I always say it's about 80% of a market is weather. You either do or don't get a size of a crop that you need. And, I think it was, we watched this weather around a lot of areas, Russia, dryness, Southwest Russia and Eastern Ukraine, dry in the wheat area. Our area was dry here in the hard red winter wheat area. That started us here a couple of weeks ago, gave us a big push up. But I think this week it was more about the Midwest weather in the U.S., and that really started to put some premium in the corn and soybeans this week. So I think it was the U.S. numbers, although certainly the focus is on the wet weather in the final harvest on Brazil soybeans. 50% harvest are pollinated in the corn in Brazil. Hot, dry there. I think that was part of it too. And Argentina, disease problems, part of it on the corn too. So I think it was us, but the others followed.
Yeah. And how much more weather premium do you think we need to put in the market, especially if we come in here next week and the forecast still look pretty wet through the mid portion of the May time period?
Well, I think you'll add risk premium to it pretty fast if these funds start to move, which, it's always one of these things, Michelle, the higher you go, the higher you want to go because you get more tech buying and more people that are short getting out of the positions. But, those targets to the upside, not unreasonable on D's corn, that 503, not unreasonable on November beans at 1244.5. But, you need the bull card each time. And, these markets are always one that build on themselves inch by inch. And I think that's what we're doing. The trade is very much aware. We've got big stocks out here. Bear spreads worked on corn last week. So, like we always say, you can't pull a bull up by its tail. So, you need to have that front end on fire to really have some solid strengths. But we are back on corn challenging those highs that we put back in January. Beans off of it about 30 cents.
No doubt. So technicals, like you said, we've had a chart breakout. Is that enough, plus weather being a catalyst to keep the funds covering shorts and maybe even moving long in those markets?
Well, a lot of people look at the charts, and you always have to remind yourself, Michelle, sometimes you get this fake out breakout. In other words, you run up and you can't go anyplace. And that probably is dependent on what happens with the weather. But, these funds really don't show a big push to get out of the market like we see some years. They maybe lighten up a little bit and then the market stalls and they sell it back. So, it looks like to me that they're willing to lighten up, but they still want to hold a short position, which is unusual because we know in the summer that we usually add risk premium. The weather's been very volatile, throughout this year so far. And you have to expect this summer it's going to be a wild weather with who knows how the forecast goes. Does it get hot and dry or what? So that's why we put risk premium in. And I think that's what we're kind of starting to do, a wake up call.
It also felt like towards the end of the week, Don, that we were seeing more of a risk on environment. Is there some new money that's coming in from other sectors of the markets into the grain sector finally?
Well, and that's another good point, because I think when you look at it at the beginning of the week, we had the Fed sending a clear signal that they don't have inflation under control. So that means inflation. That means you get raw commodity buying. Certainly, when you look at it compared to where we've been, corn and soybeans and wheat look pretty reasonable. And so that is a risk possibility that you see some of this money flow in. And, that probably helps support the market.
Absolutely. We also have the reports coming out next Friday. We get the WASD, and we're going to get both old crop, but in fact, the first new crop estimates. So that's going to be largely followed too, right?
Yeah, the May is the first time you get a balance table for 24-25, the one that we're putting in the ground on corn and soybeans and wheat. And I think when you look at it, it's hard to put lipstick on that pig. Looks like it's going to be big on corn to us. We've got our estimates about 2.5 billion plus on corn ending stocks next year. Remember, we're just around 2.1 now. We think our bean ending stock is going to be just over 383 million. We're about 340 million now. So, we certainly need some of these things to change, higher demand, acres to change, or yield to change. And of course, this time of year, all those in play and can change.
Yeah, no doubt. So if you have even a negative or a bearish report, but you have, this weather push going into that, and the market ignores some of these negative numbers, that's going to be a real telltale sign for the market, isn't it?
Yeah, it really is. I think if we get those numbers out, the weather still looks threatening, and we're moving to the upside, continuing, Michelle. I think that tells us that the trade believes those numbers are going to change, and maybe change a lot. The other side of it is if we get the weather clears out and we look at those numbers, it may be one that says, shoot, this was the rally back to the January highs. And, this is our first of maybe more weather rallies to occur.
Yeah. Although you and I have talked before about the fact that you get farmers selling on these rallies, that's going to be a headwind. How much of that are we seeing in the market, and how much do you expect?
Yeah, most definitely. I think if you look at it, the producer had 5 billion bushels of corn March 1. We think so. Let's just say he's got about 33%, 30 some percent of his corn, soybeans left to sell yet. We know they're going to be sold somewhere between now and the 1st September. Not many producers want 2 crops going forward. So, the first rally is always easier. The producer wants to move it. Not sure if more can happen down the road. So that was the anchor to start with here. I think they'll probably, if it starts to turn into something big, they'll probably lock the doors again. But I think the producer wants to move stuff on the rally, Michelle. Looked at it all winter. Was kind of despondent on it. Now we're getting at least a place that you can start to look at catch up. So it's going to be the producer anchoring rallies versus the technical buying.
No doubt. Cattle market. Well, we were a little bit higher in the live cattle futures on Friday, while the feeders were mostly lower in the nearby contracts, I would assume, on the higher corn market. But cattle came back into the end of the week because we had better cash trade.
Yeah, the cattle market, seasonally, this is the time of year that the cattle market, both the beef and the cash, go up this time of year. A little bit tougher, the box beef has just struggled. It seems that it can't stay over that 300. So maybe it's the economy slowing it down here. Packer paying up for cattle, maybe a little surprising, losing about $100 a head. Beef's not moving that well. Weights, big over a year ago, about 27, 30 pounds carcass weights over a year ago. That's about 4% of production. So that kind of is one that you got to be careful of. It feels like it's a market that eventually runs out of gas as we get closer to the end of the spring rally, Michelle. But we'll see. Numbers are just tight. What is it, 4% less feeder cattle outside of the feedlot? So the numbers aren't going to be there going forward, and the demand's going to tighten up on both the feeders and the fats down the road.
Yeah. The other question, though, is have we absorbed most of this HPAI news or the bird flu news, because the funds have been liquidating on some of the fear that they have, the uncertainty in this market, haven't they?
Well, most definitely. I think that, we saw it this last week. I mean, it was the classic where when they started testing, the trade kind of broke to the downside hard. Then when all the negative tests came out, then it's like, okay, put the risk premium back in again. I guess we better be back there. So, the cattle market's kind of opposite of the grain market. It seems like the funds are long. They want to stay long. They liquidate a little bit, but they don't get out of their long position. Just the opposite of the grain. They're short. They get out of their short a little bit, but they go back at it again when the market stalls. So, yeah, the cattle market, I mean, down the road, fourth quarter is probably the best quarter going forward. And we'll see if we can ever eclipse the middle of September highs that we put in, just over 199 on fat cattle.
Yeah. What about the hog market? The funds are still long there. Do they continue to defend that long position? I mean, we did have a lower day on Friday and a lower weekly close. And how much of that is just because the futures are ahead of the cash at this point?
Well, and that's really what it's about. I mean, the futures market normally this time of year we're about what $9 June over the cash, and we got 15 to 18 over, so just too much. Now we've kind of moved back to a more normal basis. Market's oversold down here, Michelle. The seasonals are still, for the most part, positive. The pork looks attractive versus the beef, so that's a supportive factor. We've had a lot of liquidation going forward down in this last 2.5 or year and a half, but the efficiencies keep going up, so the numbers are still there. But bottom line, I think the seasonals are still positive going into the summer.
Okay, thanks so much, Don Rose, U.S. Commodities, and that's Markets Now.